All right, good morning, everybody. Jobs Day here in the U.S., Friday, April 2nd, 2021. Welcome to Yahoo Finance Live. I'm Miles Levin, joined as always by Julie Hyman and Brian Sazi on this very special edition of the Jobs Report. For the first time since 2015, we have a jobs report coming out on a day when the market is closed. We see futures are open. They'll be open for about 45 minutes or so. Let's take a look at expectations for this report. Non-farm payrolls expected to grow by 660,000 in the month of March. The unemployment rate expected to fall down to 6%. Average hourly earnings expected to go up 4.5% over last year. We've talked a lot about that number normalizing. Compositional effects have really distorted the average hourly wages because so many workers who lost their jobs, I would venture to say the vast majority of workers who were laid off during the pandemic are on the lower end of the wage scale. So we have seen really just gangbusters average hourly earnings figures over the last year, but we expect this number to moderate as more lower paid workers come back into the workforce. That, of course, would be a sign of healing within the broader services sector. When we mentioned futures, let's take a quick look at what is happening right now within the markets. We see Dow, S&P, and NASDAQ futures are higher this morning ahead of this jobs report. Again, the U.S. stock market will not open today. Futures are going to trade for about the next 50 minutes or so, and then we'll be quiet for the long weekend. This, of course, is Good Friday, and we have Easter on Sunday. UK markets actually closed today and as well as Monday, bank holiday over in the UK. So coming off that record close yesterday, S&P futures right now trading just above 4,020. Dow futures sitting right above 33,000. Well, as we await this jobs report, let's talk, Julie and Brian, a little bit about some of the numbers we're looking at. Something that I want to highlight just off the top is U6. This is the broader measure of unemployment, counts both those unemployed as well as folks who are underemployed, stood at 11.1% last month. And Julie, for a long time, this was called, shadow unemployment rate, real employment rate. But I remember Gary Cohn started talking about this back when he was chair of the CEA, and Jay Powell himself has mentioned the U6 unemployment rate as something that he would like to see come down materially. It stood at 7% ahead of the pandemic before the Fed gets interested in really thinking at all about changing its policy.
Yeah, it's funny because that so-called shadow rate was sort of political for a little while, right? It was during the Obama administration in particular, it was sort of a way for some GOP speakers to poke holes in improving employment picture. It seems to have become a little less politicized as of now. Within that rate, by the way, I'm taking a look at, and within the overall unemployment rate, the sort of top line one, I'm looking in particular at the constituents. So, for example, women who, as we know, have lost jobs at a higher rate during this pandemic, or if not lost jobs, many of them opting out of the workforce because they need to stay home and take care of kids who didn't have school to go to, for example. So 6.1% is where we stand with the female unemployment rate. Also watching the black unemployment rate at 9.9%, so still elevated there. As we have talked about, it's become really just conventional wisdom during this pandemic that this has laid bare some of the divisions within the economy. These are a couple of them that I'm going to be paying close attention to when it comes to watching the constituents of the numbers. Brian Sazi, what about you? What are you looking at here?
Hey, I'm simple here. I'm just looking at the non-farm payrolls headline number. It's time to get a good number that smashes estimates. We've seen estimates all over the place. We've seen friends of the program, Hugh Johnston, he's looking for a 450,000 increase. Michelle Meyer over at B of A, a 1 million increase. And we've seen consumer spending data tick up. We've seen S&P 500 targets tick up. We've seen earnings estimates rise. It's time for this report to start blowing away estimates in large part because of stimulus expectations. But I think the market is waiting for a good report here. It needs it.
Yeah, and it's interesting, Sazi, coming off that ADP number that we got on Wednesday, which again was a good number, but just slightly light of estimates there. We've been hearing for some time now from economists that we are going to see jobs gains in the millions, perhaps even 2+ million per month as we get into the summer here. Remember, we're still 9.5 jobs below where the economy stood in February of 2020. So we are still well off of that high watermark. But again, as you mentioned, estimates kind of all over the place for March. Not a huge sense that this is going to be the month that will get a mega block buster figure. All right, let's head down to Jessica Smith, who is live with the numbers on this Jobs Friday as they hit the tape. Jess.
Yeah, Miles, non-farm payrolls rose by 916,000 in March, beating expectations of 660,000. The unemployment rate fell to 6%, right in line with expectations there as more people get vaccinated and jobs do start to come back. Looking at the number of people on temporary layoff, that fell by 200,000. That is still 1.3 million higher than this time last year. The number of permanent job losses is now at 3.4 million, little change from the month prior, but still about 2 million higher than February 2020. Now, if we also look at the labor force participation rate, that's little changed at 61.5% in March. And then we also want to look at some of the sectors here that stand out. Leisure and hospitality added back 280,000 jobs. Employment increased in public and private education as schools start to come back. Construction added 110,000 jobs. Manufacturing brought back 53,000. We also want to check out the revisions here. The January jobs number revised up by 67,000. The number for February revised up by 89,000. So with those two together, that's 156,000 more jobs than previously reported. Average hourly earnings fell by 4 cents to $29.96 an hour. But again, that big number, non-farm payrolls rose by 916,000. The unemployment rate fell to 6%. And we are going to be hearing from President Biden about these numbers at 11 o'clock today. He's set to give brief remarks. We'll be streaming that here on Yahoo Finance.
All right, Jessica Smith with the initial breakdown there of the jobs figures. Jess, we had the guidance that Biden was going to speak, as you mentioned, in a couple of hours. Maybe that should have been the tip. There was a story a couple of years ago, the Fed chair, the president, and I think one other person, they get to see the numbers the evening before. So if we knew the president was going to come talk, maybe we should have said it was going to be a big number. But again, 916,000 on that headline, non-farm payroll figure, 280,000 jobs created in the leisure and hospitality space last month, guys. 384 was the leisure and hospitality number that we saw back in February. So put those together, and we're looking at job gains in that sector north of 600,000 over the last couple of months. Julie, we know, again, there are millions of jobs to be gained within this sector specifically. I think as we get into some of that seasonal hiring that we might see as we get into the summer months, school comes out of session, restrictions are lifted, vaccinations roll out, and so forth. But I think to see a couple of, strong, let's call it mid six figure gains in that sector certainly encourage as we start to, really feel the tailwind of an economy reopening.
Yeah, I'm just going through some of the other numbers here. Construction, I'm not sure if Jess hit on that one, 110,000 jobs in March. And it's interesting because we have been watching some jobs numbers that have been sort of choppy, in part because of lack of supply. So looks like construction is busy at work trying to build more houses, although supply also has to do with existing homes, which is a much bigger part of the market. Professional and business services, which is an area that had waned a little bit, I believe, in February. 66,000 was the increase, although it is still down compared with where we were pre-pandemic. So interesting little areas here. Transportation and warehousing, for example, up 48,000. So not surprising there. That has been an area of pretty consistent strength because it has been fueled by what's going on with people ordering things over various websites. I was mentioning before the report that I'm looking at the unemployment rate among the various constituent groups. For adult women, it ticked down a little bit to 5.7%, the overall unemployment rate. For blacks in this economy as well, 9.6%, a little bit of an improvement, but still a long way to go, and obviously still there, a big gap between various minority populations and the broader population. So that's something to continue to watch as well. Sazi, what sticks out to you in the numbers? We got your big, you were looking for the big number. You got the big number.
Yeah, and I don't like making predictions, Julie. You know how I feel about that. But listen, I think this is the most The most important line in this report might be, and you can appreciate this, this could be a Goldilocks report, as they would say on Wall Street. And I'm looking at the average hourly earnings for all employees on private non-farm payrolls fell by 4 cents. Average hourly earnings for private sector production and other workers at $25.21 changed little month over month, actually up 2 cents. So if jobs could be created at this level, 916,000 that we saw on the headline, and you have wage inflation contained, this might be a good thing for the market, because Miles and Julie, as we've been talking about really for the past month, this is a market that has been petrified of inflation. And because of that, it sent the 10-year higher to, I believe, a 14-month high, and you've seen stocks under pressure as a result. So this could be a good positive takeaway from this jobs report.
Yeah, and Sazi, as we mentioned, that compositional impact on the average hourly earnings figure, that's weird to say, but you want to see that number come down, because that number has been, again, greatly distorted by the fact that white collar, higher earning workers kept their jobs in much higher numbers than those who earn less on the overall wage scale. All right, as we mentioned, markets closed today. We do see futures trading just a little bit. Futures are higher after this report. Jared Blickery joins us now for a look, Jared, at what is moving, considering what is open this morning.
Well, Bitcoin never sleeps, right? We'll get to that in a second. In all seriousness, this is a very risk-on and risk-friendly report. I agree with Brian 100% that the wage inflation, not there. Strong payrolls number, headline number, extremely productive here. So the markets are running with this. And we're also seeing a rise in the yield curve. So the 10-year T-note yield, which we'll take a look at right here, these are actually Treasury futures right now. So these are heading down. That means that the yield is heading up. I was looking at that 2s10 spread. That has expanded just a little bit. All the traditional commodities like WTI crude, gold, copper, those are closed, but we do have currencies, and we'll take a look at the euro, which is looks like it's break even right now. Let's take a look at a chart here, and we do seeing it head a little bit lower on the report. That means the dollar is just a tad stronger. Not a lot of markets to look at here, but we will take a look at Bitcoin. We can see that's up about 2% here, and just taking a look at the trailing month, we can see just knocking on the door of this record high we had earlier just a few weeks ago, guys.
All right, well, Jared, if Bitcoin wants to join the big leagues, we're going to need Bitcoin to start reacting in size to the U.S. jobs numbers, because that, of course, the mark of any market is when we see this number pushing things around all over the place. All right, let's stay on the jobs report and talk a bit more about what to take out of these numbers. We're joined now by Joe Brusuelas. He's the chief economist over at RSM. We're also joined by Emily Rowland, the co-chief investment strategist at John Hancock Investment Management. Thanks to you both for jumping on this morning. Joe, let's just start with your view on this jobs figure and kind of how you're thinking about these numbers, given we've seen a 900 plus thousand non-farm payroll report.
All right. So not only were the jobs created strong across the board, they were also clustered in some very high-paying industries. If you look at those additions in goods producing, 183,000, construction, 110,000, manufacturing, 53,000, government, 136,000, education and health, 101,000. This is the boomer of a jobs report. Moreover, you add in the, 156,000 back revisions over the past 2 months, we had over 1 million jobs. Turns out my forecast of just 1 million wasn't quite optimistic enough. Hey, look, when you look at the composition of this, I come to one conclusion: the best is yet to come.
So if the best is yet to come, Emily, is the best yet to come for the markets, right? I mean, it feels like stocks have been pricing in some pretty optimistic numbers when it comes to GDP, when it comes to jobs. Are they? Or, I mean, we're seeing futures take a leg up. How are you thinking about these numbers?
Yeah, thanks for having me this morning, everybody. And Julie, I think you're right. This story is really becoming about the economy just booming this year. And in some sense for investors, that's kind of a gimme. We're coming off really depressed levels. We still have 8.5 million jobs left to restore, but there's a lot of momentum right now. And this report this morning was awesome. We are seeing futures up here a little bit. Bond market, you're seeing a little bit of a backup in treasuries, but a lot of this has been priced in. So if you think back to 2020, that was really a market of multiple expansion, of stocks moving higher in anticipation of this reopening, in anticipation of vaccines being rolled out in the US. And now it's really more of a show me story. Is the hard data going to show up and exceed or meet these lofty expectations then that the markets have priced in? And in our view, it's going to be a little bit more challenging to get those exceptional returns in the market as we head forward. We are confident that this better economic backdrop will feed through to corporate earnings. And so we do think that earnings engine is going to be there in order to kick markets into gear and continue to climb higher here this year.
So Emily, in addition to the headline coming in strong, 916,000, you had 156,000 worth of upward revisions to jobs in January, February. So all that is good. Positive. Clearly, the economy is kicking into gear. So come Monday morning, are you rotating out of value and back into growth? Because I would make the argument that it's time for growth to start picking up here. It hasn't done well, but these jobs numbers say growth should be doing well in this type of environment.
I would expect the rotation into more cyclical or economically sensitive parts of the market to continue here. So, I do think that value will continue to catch a bid as the economy is turbocharged here with more fiscal stimulus and with vaccine rollout. So that really benefits areas like financials and industrials, which are our favorite pick. The other way that I would think about this, though, is from a U.S. versus non-U.S. equity standpoint. This report is providing further evidence that there is a multi-speed economic growth backdrop unfolding here, with the U.S. economy accelerating faster than the rest of the world, with potentially the exception of China. So for us, that's meant having an overweight to U.S. equities, looking to areas like U.S. financials and U.S. value to play the cyclical rotation, and having an underweight to European equities, as unfortunately their economic growth backdrop is stalling a little bit.
Joe, you mentioned the best is yet to come, at least, kind of in your view, given what we've seen in these numbers. How unique of a period then, given kind of how you've seen the economy evolve over your career, how unique a period are we heading into where we're going to be looking at 7-figure job gains? We could be looking at GDP prints in the high single digits, maybe even a 10% quarter at some point this year. And how challenging might it be for investors in the broader kind of, market community to see through these numbers, understand them for what they are, instead of have, the inflationistas come out and start calling for overheating and all these sorts of things that are certainly coming.
Okay, this is going to be the best growth we've seen since the 1980s, the best job creation we've seen in terms of the composition since the 1980s. Just because you're seeing an economy reflate does not necessarily follow that you're going to have inflation. In fact, I think one of the major arguments back in the 1980s was, wow, we can have quality growth without having inflation. And I would make the case that, well, we're going to see inflation rise just due to year-ago base effects, largely due to the recovery in the price of oil. Remember, a year ago, March, oil was averaging $31 a barrel. It was $61 a barrel last month. So you're going to get the arithmetic of that. But then you're going to see it ease simply because this economy is just ready to take off. When you unpack those numbers further, you can begin to see the reflation in restaurant and bar hiring. That's where a lot of the damage was. Now, I do think that there are two major policy takeaways here. First, when you take a look at the fiscal aid that's in train into the economy, I think you could see better reports in April, May, and or June. I mean, you're going to see some really, really strong numbers here. Second, I think this does pull forward the clock when we're going to see the Fed begin to openly talk about tapering operations later next year. And of course, that will likely pull forward the first rate hike into 2023. Now, I don't think the Fed's going to move off of one report. But if the type of composition in terms of hiring, and of course, you're going to see some nice wage data going forward as people begin to work again, in addition to the trillions of dollars sitting in cash accounts and in household savings. It's hard to make the case here that you're just not going to see the best economy in anyone's memory, really in our career arcs. This is going to be just an exciting year, and I expect 2022 to be just as strong.
Well, Joe, let's stay on policy here because clearly the economy is kicking into high gear. I remember you telling us last month we'd be looking at million-plus job gains in the months ahead.
Yep.
And I imagine this is a pretty good day for the Biden administration. Does this make the case easier for him that this economy can handle higher corporate taxes? This economy can handle higher taxes on people making more than $400,000 without, the economy tanking.
Right, and we saw that in the 1990s when taxes did go up, but the rate of growth was so strong, people really didn't notice. I think if I'm thinking about this, well, pre-tax hike, I would have thought next year we'd have about 5% growth. Well, that may be closer to 4 if they follow through and get the sort of tax plan that they're proposing. We're in early days. We don't know. We're a lot of speculation here. I think in terms of policy, though, you see growth like we're going to see this year. You see these employment numbers, people start to feel a lot more confident. That gives the Biden administration greater degrees of freedom to pursue their very ambitious infrastructure policy. As an economist, when I look at that infrastructure proposal, I don't really see spending. I don't really see taxes. What I see is, okay, if they do this, this will result in a 0.4 to 0.5% increase in productivity per annum. Now, today, productivity means very little, but over the long term, it's absolutely everything. That's how we increase the living standard, the overall welfare of the economy and the nation. You stick the landing on vaccines, you stick the landing on resuscitating the labor market, people are going to let you engage in transformational projects such as infrastructure. So one would imagine our friends over at the Council of Economic Advisors inside the White House, big smile on their faces as they're looking at their terminals this morning.
All right, Joe Brusuelas, Emily Rowland, thank you both for jumping on this morning. Hope you guys both get to enjoy a long weekend on the other side of this. And I know we'll talk to both of you quite soon. Really appreciate the time this morning.
Thank you.
All right, off for a short break here. A lot more coming up on this Jobs Friday. Again, blockbuster number, 916,000 jobs added back to the economy in the month of March. Stock futures are higher. Back with more right after this.
Well, Emily Rowland just called it an awesome jobs report. Certainly a big beat in the top line non-farm payrolls numbers with 916,000 jobs being added to the U.S. economy last month versus 660,000 expected. The unemployment rate falling to 6%. That was as expected. Average hourly wages ticking up a little bit less than had been anticipated, perhaps because more jobs being added in low-paying professions. Let's dig a little bit more into the numbers. Brian Chung is with us now. And Brian, you're looking below the headlines, of course, to looking at things like permanent job losers and what that tells us about this economy.
Absolutely. And when we look at the headline number, obviously an eye-popping figure for the month of March. And the expectation is that in the future, that number could be even better as schools reopen. When you look at, for example, education, local government education still remains about 500,000 below pre-pandemic levels from February 2020. So as schools reopen, teachers go back to work, that could really bring some eye-popping figures in months to come. But I want to point out that there are some concerning figures that are part of this March jobs report as well that could especially catch the Federal Reserve's attention with regards to maximum employment. The figures on permanent job losers and the long-term unemployed showing that the Fed is still pretty far away from maximum employment, even despite this pretty impressive March jobs report. So permanent job losers still remain at 3.4 million, despite the headline gains on non-farm employment. That's a tick down from 3.5 million that we saw in January and February, but obviously that's not a considerable decline. Same story with long-term unemployed. It remains steady at 4.2 million. That's about 3.5 times where we were pre-pandemic. Of course, this raises questions about how we got those payroll ads when those types of figures are not changing. So are the flows coming in for those on temporary layoff? JOLTS report might give us a little bit more granularity on that. The question is, of course, is going to be what is going to happen to those millions of people that are on permanent job losses, especially if those figures don't continue to tick down in the future. And one last thing I want to point out, Julie, is that the compositional effects as well have been pretty disparate across different classes, especially when you look at the Asian unemployment rate having the most notable uptick among other people that were looked at in the BLS. The unemployment rate for Asians now up to 6.0%. That's up from 5.1% in the last month, whereas the unemployment rates for whites, blacks, and Hispanics had gone down between February and March. You could say to what degree that might have been influenced by the shootings in Atlanta, as some of those low-income workers maybe fear going back to work, but something definitely noticeable in that part of the jobs report as well.
Yeah, that is definitely an important thread to continue to explore. Thanks for pointing that out, Brian. Brian, stay there. We want to bring in Neela Richardson now. She's ADP chief economist. Neela, it's always great to see you to dig through these numbers. First of all, I'll just ask your broad takeaway and sort of if there's anything in particular that stands out to you in this report as important, more important than the rest.
Well, it's hard to dismiss any piece of information in this report as we're trying to figure out what's next for the jobs recovery. What strikes me and what struck me with ADP's number on Wednesday is how broad-based the job gains had been. You saw it in both goods and services. You saw it in construction. Finally, manufacturing is starting to behave in terms of growth the way the manufacturing survey said that it would in February when they reached a 3-year high. So we're seeing a consistent pattern of growth across industries, and those industries with the most room to run, which meant that they were the hardest hit by the pandemic, are surging more in this report, and that's namely leisure and hospitality.
Neela, a lot of jobs created in the month. Where's the wage increases? I didn't see it in this report.
Well, I'm not actually worried. That's the one number I'm not worried about because it is those low wage jobs that were hardest hit. So at ADP, we saw that people who made under the minimum wage were impacted. 40% saw job loss. So we want those people back to work, and that's going to depress the overall wage gains because lower wage jobs are coming back to the fold. Those leisure and hospitality jobs, the lion's share, are going to be at the lower end of the income spectrum. That's okay because those are the hardest hit industries. So we're going to see that number go down. Same with the the unemployment rate. We may see that go up. That's not going to be a bad indicator if it meant more people are coming into the jobs market because they are lured by better opportunities and comforted by a safer work environment.
Hey, Neela, Brian Chung here. Important point there on how the unemployment rate doesn't tell the whole story. I was looking at permanent job losers and long-term unemployed, which kind of remain unchanged despite that headline gain on non-farm payrolls. So was there anything about this report that told you about the flows in and out of the labor market? Because that seems to imply it's mostly short-term layoffs that are coming back at this time. But what are you seeing about who's coming back to work at this time?
Yeah, that's what we're seeing. It's those temporary workers. And if we could remember, we're about a year since the pandemic hit, since we first saw that big change in what had been a 50-year low in the unemployment rate. If you go back with me to March of last year, the promise was always that these jobs were temporary layoffs, that 80% of these jobs were temporary. But the longer the pandemic has been in place, the more likely that some of those temporary losses became permanent losses. And that's where things get scary. In terms of the future of the jobs recovery and the future of these workers, because that's when we're starting to talk about permanent scarring in the labor market, because the longer you stay out, the harder it is to return, particularly for impacted groups like women, like minorities who are seeing higher rates of unemployment. The longer these groups stay out of the labor market, the more scarring that occurs and their opportunities to come back. So we're always going to be and I will say here, that's what the Fed is also going to be looking at, not just the overall unemployment rate, but as they've indicated and signaled, even in this past expansion, they're looking at the disaffected groups by the jobs market.
And Neela, to follow up on that, what do you think is the outlook for those folks coming back into the market? I mean, for a lot of women, as I mentioned earlier in the show, it had at least something to do for some of them with childcare during the pandemic when their options were very limited. So once that starts to reopen, though, will women it's not like flipping a switch. You can't just jump back in necessarily. So what's your outlook for these groups?
Here, I think the education hiring is really impactful for women in particular, because we're actually seeing this reopening of schools and daycares, and you're actually seeing it play out in this month's report. That's a good sign for women going forward. I say that the best technological advantage for a woman is a good babysitter if she has children, because that's one of the necessary infrastructure improvements that women need who have children to go back to work. But that's a good sign. But you're right. This is not just going to be a switch that we flip on and flip off. It's more like a dimmer. And hopefully we'll see women transition back into the labor market. But what they find when they get there, their jobs may have changed. Some of the tasks may be automated if they're in these hard hit professions like call centers or leisure and hospitality. The opportunities in terms of wages may be different. So we always have to keep our eye on the ball of the disparities when it comes to women and wage gaps and promotion potential, because those have been exacerbated by the pandemic.
Really good points and things to watch here, Neela. Thank you so much. Appreciate it. Neela Richardson, ADP Chief Economist, and our Brian Chung as well. Well, that does it for our quick special here on the jobs report this morning on this unusual day when most markets are closed, including the equity markets. Guys, any final quick thoughts here? Brian Sazzi, I know you always have some.
One, I wish the market was still open. I'll be that guy. Number two, really like what Emily Rowland said to us earlier. Watch how the markets open on Monday. In this jobs report, a whole lot of stocks should work, not just value. Really, we're talking SPACs. This is a very good jobs number. I wouldn't be surprised to see some form of a rally on a Monday.
I'll see you back here in April 2026 when it looks like the calendar is going to line up. So we're going to have another one of these Good Friday jobs reports. That's all I got.
Miles looking ahead to 2026 when the S&P 500 will be at 6,500. There we go. There's my
so
prediction.
Julie? That's so conservative.
All right, everyone. Thanks so much for tuning in. We want to tell you we are not done here on Yahoo Finance Live. We three are done. But Labor Secretary Marty Walsh is going to be joining our editor-in-chief, Andy Serwer, at 9:55 a.m. You can please stay tuned for that. And as we mentioned, President Biden is going to be making some comments at 11 a.m. We will be taking those comments live as well. Have a great weekend, everybody. We'll see you back here on Monday.